Hello, and welcome to another edition of Equitile Conversations. I'm Gerald Ashley, and once again, as usual, I'm joined by my good friend and colleague, George Cooper. George, good to hear you again.
Morning, Gerald. How are you?
I'm well, though I don't think we're going to have a particularly optimistic conversation today because I think it's time to talk about supply chains and the whole US war that is unfolding in the Middle East. And of course, from our perspective, the impact on financial markets. Let me just throw one or two thoughts at you to start off with, George. Back in January, we talked about the market was starting to move towards physical assets, and that there was this feeling that you had to have stuff rather than just sort of digital code, and that financial markets were starting to see the value in companies that did things and made things. Now, of course, we had no idea this war was going to break out, but this has now really heightened that situation. Everybody's suddenly talking about supply chains. I can't let that go without the sort of joke misquote of Rousseau, which is to say that all men were born free but end up in supply chains. And of course, we are all in supply chains. What's your take on the general big picture here, George?
I think we should say, actually, before we get into the conversation, we're recording this on Sunday, 29th of March. And I say that just because things are changing so rapidly that everything we say today could be out of date within a matter of hours. But having said that we're recording it on Sunday, 29th, as things stand, it looks like over the weekend we're seeing a pretty dramatic escalation of the conflict in the Gulf, with the US now planning to send in ground troops into Iran, which looks like it's going to exacerbate all of these supply chain shocks. As things stand, I would say we're looking at probably the biggest energy supply shock and related commodities, fertilizers and other things that we've seen in modern times. And because so much of the infrastructure is being destroyed in the Gulf, I think we've got to assume that this supply shock is going to be measured in months, quarters, or even years. So this is not going to be something where they can suddenly sort of kiss and make up and everything goes back to normal.
So this is a really big deal, and this is the second time that Donald Trump has sort of thrown a really large rock into the pond. We had his tariff announcements almost a year ago now. I think it was in early April of last year. But the market quickly recovered from that as, to be honest, he rode back from the initial announcements. And then there's been a lot of toing and froing and negotiating as to what has actually happened with tariffs. And the market shrugged it off. It was a extremely volatile April last year, from memory, but we moved on. That doesn't feel the case with this situation.
No, I don't think it is the case. And I think at the moment, it appears to me that it's not in Donald Trump's power to row this one back. It's within his power to keep escalating it, which seems to be the path he's going for. But it doesn't seem that he's got a path to turn it off, because the Iranians don't seem to want to come to the negotiating table.
And I think underpinning all of this is our old friend time and timing. Financial markets, as we know, live by the sort of nanosecond these days. And as you just said earlier, any scrap of news in either direction is very quickly leapt upon. But in the case of supply chains, or if we want to be slightly more in economic terms, call it a negative supply shock, these things take a little while to unfold, or in this case, break apart, but probably even longer to put them back together again. So is it fair to say that we're in the early stages of the breakdown of supply chains, and there's probably far worse to come?
That's the way it's looking at the moment. I mean, there's been some short-term attempts to sort of dampen the shock. There's the announcement of releasing strategic reserves. There's the the pretty remarkable de-sanctioning of Russian energy and de-sanctioning even of Iranian energy. So allowing the what's called oil and water to be sold into the market. And that sort of brought oil back down from, I think it was $120 a barrel was the original spike. But in the last few days, it's started moving up again. It's above $110 now. So you just hear the stories, the stories of petrol stations running out of fuel in different parts of the world. It does feel like it's tightening, and I think that's what we're seeing in the physical markets as well.
And as ever, there are second-order effects because it's not just oil. It's one of the big ones that seems to be heavily involved in this is going to be production of fertilizer. And I read a report just yesterday that Australian farmers are running out of diesel just as they start their growing season, and they're worried about future supplies of fertilizer. Okay, that doesn't affect food in the shops next week, but it may do come August, September, October time.
Yeah, I think that's a good point, Gerald. And what I think this is lining up to be is a pretty durable energy shock, and then a pretty durable food price shock. Given the growing season, the length of time it takes to grow crops and get it into the food chain, if there's a problem planting now, we're going to see inflation, I guess, 6, 9, 12 months' time. So we've got an immediate inflation shock, and then we've already got a pent-up inflation shock coming into food supplies. So I think this is going to start to look like a pretty protracted, dare I say it, 1970s, late 1970s style inflation cycle. There's a lot of people, you'll see them on Twitter circulating this chart showing the sort of triple peak of inflation in the 70s, which ended in the early 1980s. And what we're now going into is looking eerily close to a repetition of that, with the biggest inflation peak being the third one that we're probably going into now, I think.
Well, I did warn listeners that we weren't going to be overly cheerful, and I'm afraid that does, ground us in what could be the realities going forward. One element in all of this is going to be the action of central banks. I see the ECB have already made noises that they may have to consider raising interest rates if this persists. And I think it's fair to say that the Bank of England is at 6s and 7s, having looked like it was definitely cutting. It's now umming and ahhing in public about what it might do next, none of which can be good for confidence in the markets or with the consumer. Would it be sensible or potentially a big mistake to raise interest rates now?
If you follow the textbook recipe, you would raise interest rates.
Right.
Because we've definitely got higher inflation coming, and that's the textbook response. Personally, I think it would be the wrong response. And the reason I say that is I think interest rate policy is good for dealing with endogenous inflation dynamics. And that's an economics term. What that means is internally generated inflation.
Yeah.
So if the economy is running very, very fast and is overheating, and it's generating its own internal inflation, then it's sensible to put up interest rates and try and slow things down. But if the inflation is coming from an exogenous shock, an external shock, as it is now with the energy prices, then I think you run the risk of sort of compounding the trouble by having the economy hit by an energy price shock and then hitting it again with an interest rate shock. And that's, I don't see that that's necessarily going to fix the energy supply issue. You're not going to pump more oil because you've got higher interest rates. In fact, if anything, you're going to run the risk that you reduce the necessary investment that's needed to correct this energy shock.
Yeah.
So it might actually exacerbate it. So I think it's going to be a mistake if they do hike. I really hope that the central banks can look through this. But of course, they're on the back foot because they've allowed inflation to come into the system after lockdown. So they might feel that they just have to do it.
Yeah, they're not in the best sort of part of ground to fight this next battle, are they? And that also sort of prompts the thought that if they do raise, to get things back on an even keel in a growing economy, we would be talking some months in, no, not months, I mean years in advance, I think.
As you warned readers that this one might be a more downbeat podcast, but I think there are times to be upbeat and there are times to be realistic. The other thing that's hitting the economy at the moment is we've got a problem in the private credit markets,
Yes.
which is this is a sort of interrelated thing. We've got I think probably the start of the the financial markets questioning the investment boom in the AI sector, asking themselves, is this really going to be viable?
Yeah.
And a lot of that's been funded with private credit. So those two booms or bubbles, I think they're bubbles myself, are perhaps bursting at the same time. And of course, the big issue that was always hanging over the data centers is, could you actually get enough energy to supply them? Well, now we're in an energy shock. The cost of running those data centers has just gone up dramatically. So the economics is deteriorated.
Yeah, the maths completely changes now in terms of the viability of doing some of those things. Just to flesh out the background as well, particularly in the UK and of course in the United States, but I think most of Western Europe, um, we're not in a good financial position on the sort of fiscal front. The British government or administration continues to need to raise taxes in an effort to sort of get ahead of the amount of spending that is still happening in government and the rest of it. So how do we start to square all of these circles, if I may use that strangulated term?
Um, this is a pretty serious supply shock into a market that's got very low elasticity. In other words, prices are going to go up, but still people are still going to demand the energy. So that runs a risk of a price spiral.
Hmm.
How do you deal with that? I don't think you can deal with it other than try to address the demand side,
Yeah.
which is what we're already starting to see. We're starting to see, I think Egypt has already asked restaurants to close early, and other places in the world, I think some Asian countries are asking for 4-day working weeks, working remotely. I think that governments are going to respond like that. We're going to be, if we were banging pots and pans for the NHS in lockdown, I don't think we'll be very far from, oh, you shouldn't be driving your SUV because the ambulances need the diesel. I think we're going to go down that sort of path.
Right. And this, in a sense, is the ripple effect of as these supply chains break down or become blocked in some areas. And as you say, it could take a long time to bring things back into balance. And the supply chains themselves, I mean, I think the lessons of COVID was, as we know, markets and people do adjust, and hopefully they adjust quite quickly. But I know it's a cliche, but we are in such an interrelated world these days. It seems it could take a very long time to put things right. One other element to this that sort of comes to mind, I think I've said on a couple of podcasts, my new favorite word is trillion. And trillions are now coming up all the time. And the big one, of course, is the US deficit. This time last year at $36 trillion, now just going through 39 and heading towards 40. And projections were done before the cost of this Middle East situation. So yet more pressure coming on that front.
I actually think there's an even bigger issue behind the Iran war, and this is really big geopolitical questions. I mean, you could ask the question, is the Iran war pushing up the U.S. debt? you could reverse the causality, and you could say, is the US debt causing the Iran war?
Right.
In the reason I say that is the debt load in Western governments now so high that the economy's in distress, and the governments of those countries are now looking for a scapegoat. They're looking for a diversion.
Yeah.
They're looking for something to distract the electorate from a problem that they've got themselves into. I think there's in economics, frequently causality runs in both directions. I think this is one of those cases.
That's quite a cynical view, maybe, George, but may well be right.
Well, it might be cynical, but one of the favorite little factoids that I sometimes like to point out to people is, on a close reading of Keynes's famous book, there is a passage in Keynes's book where he explains that war is a good way to stimulate the economy.
Mm.
And, unfortunately, it's true. It causes spending. It does cause stimulus. He recommends, I think it is in the same passage, building pyramids,
Yes.
burying money in disused coal mines, or even starting a small war.
That's a sobering thought. Just to widen it out a little into the geopolitical sphere, though not ignoring the market reactions, we often on this podcast give you the opportunity to educate us a little bit more on physics. And you mentioned earlier the fact that maybe the markets feel somehow or another everything's going to go back to normal. Either the Americans win and it's a slam dunk, or there's some sort of so-called off-ramp, everybody calms down, and the whole thing goes away. I know that's not your view, and you've got a bit of a physics take on it.
Yeah, this is, for listeners, this is something Gerald and I were chatting about before we started the recording. So in physics and engineering, there's a concept known as the elastic limit. Basically, if you're operating within the elastic limit, if you stress a system, so you squeeze a spring or stretch a spring, if it's in the elastic limit, once you take away the stress, the system goes back to its original configuration. But if you stress it so much that it goes beyond the elastic limit, when you take away the stress, it doesn't return to the same configuration. And I think that's possibly what's happening in the world at the moment. I rather fancy that even when the Iran conflict finishes, the global economy is not going to revert to its old configuration. I think we're probably going to have reset the geopolitical power dynamics. I suspect the way things are looking at the moment, I suspect we exit the Iran conflict with China, possibly Russia, in a much stronger position, and America in a much weaker position.
Right.
And I think that's also going to ripple through to the role of the US dollar in global trade. I think we might be accelerating. Demise might be too strong a word, but the world was already, I think, rebalancing somewhat away from the dollar towards a more multi-currency structure, and even a gold-backed structure. I think we've probably accelerated that by a couple of decades in the last couple of weeks.
Maybe in a few years' time, looking back, Trump will be remembered for two things: the tariff tantrum, as we called it, and now this event that has actually really weakened US global power, not strengthened it.
Yes, I mean there's two analogies that we've both kicked around between ourselves, Gerald. There's the Suez crisis, where after World War II, Britain still had illusions to being an imperial power, and that was sort of knocked on the head with the Suez crisis.
Sure.
And then there's another one, which is the Gallipoli debacle, which may also be analogous to what's about to happen in Iran, both of which were major sort of shots across the bow for the British Empire, we might be seeing this for America at the moment.
Yeah, I mean, just a little bit of context for Gallipoli for people who are not deep into First World War history. This was an attempt by the British to sort of strong arm Turkey from getting involved in the war. They were neutral, and to seizing the vital choke point, the Dardanelles. So here we are again, a big shipping route that was considered absolutely vital, maybe not as vital as Hormuz is these days in the global economy, but seen as incredibly important. The British completely misread the situation and thought it would be really quite easy to sort of kick the door down and make demands of the Turks. And it didn't work out like that at all. And as you say, it's a debacle. So I must say, when I hear Donald Trump sort of blithely talking about invading Karg Island and boots on the ground, I have similar fears. But of course, we shall just have to see how that unfolds over the next few weeks.
And as of yesterday as well, we do also have the risk of the Red Sea being closed again.
Yes, which again, maybe this is maybe one for the armchair admirals, but this is yet another choke point which would be controlled by missiles from the Houthis, who sometimes are characterized as just a bit of a warlike tribe. I think a little bit more than that, as they seem to have surface-to-air and surface-to-surface missiles. So they're certainly a little bit more sophisticated than just a warring tribe.
Well, actually, since you brought that up, I think there's another dynamic which I'm finding quite interesting, and I think we've seen it in the Ukraine conflict, or the first signs of it in the Ukraine conflict. And I think maybe we're now seeing it even more in the Iran conflict. And that is, are we seeing a major shift in the functionality of military technology? And I've sort of characterized it as, are we seeing a situation where mid-tech trumps high-tech? In other words, the relatively cheap drones and missiles can be used in swarms and in sufficient numbers that they render the big aircraft carriers and the super fighter jets that cost hundreds of millions each, they render them not entirely useless, but uneconomic.
Yeah, I mean, this is the so-called asymmetric approach to warfare, where, maybe it's David and Goliath, but maybe that's not quite the right picture. But certainly, as you say, the mismatch in weaponry may be not what we think. And most importantly, as you just said, is the mismatch in cost, because drones are almost, as cheap as chips, so to speak. And some of the missile technology that's been deployed in Israel and the United Arab Emirates for air defense is millions of dollars a go. And, also it takes a long time to produce more of those. So could we get a situation where high tech gets overwhelmed because it's impossible to produce enough of the stuff in a given time frame?
Yeah, and I think this is, it feels almost glib to try and to bring this back to investments and consequences for monetary policy in that, but that is the day job. If that is the case, then it becomes much more difficult for America to project power over great distances.
Yeah,
It's much more expensive for America to continue dominating the Middle East. If America therefore cannot dominate the Middle East, then does Iran and perhaps Iraq? I mean, we've seen elements in both countries now working together rather than against each other, as has been historic. Could we see that region emerging as a new regional superpower? Russia perhaps being strengthened, China being strengthened, and we quickly go from a monopolar world into a quadrupolar world. Who knows?
and this is your physics point that maybe we've stretched the old model so much it breaks down and something new will have to emerge. Now, as you said, we're just on the 29th of March here. Lord knows how the first week of April and the next few weeks are going to go. But I think hopefully we've sort of covered the main points for people to think about and to look at. So no more on the Middle East and geopolitics for today, though I suspect we will almost certainly come back to it in future episodes. And let's move to our books. As usual, I always barge forward and go first. And on this occasion, I'm not going to recommend a book. I'm going to recommend a little bit of online software, a game, in fact, called The Beer Game. This doesn't involve lots of drinking, for those of you who feel the need to be cheered up after this podcast, but what it is a rather nice bit of modelling that looks at how a brewery and a wholesaler and a retailer manage the supply chain of beer. And so it seems quite a good time to talk about that now. In the show notes, I'll put a link, an explanation of what the beer game is and its history. It goes back to the 1960s. It's not a new thing. And one or two links of where you can just click on it and for free, you can have a go and see if you're any good at managing the supply chain. So the beer game. And George, I think you do have a book.
Yes, I'm going to continue my my biographies of interesting entrepreneurs, and so my book this podcast is Tiny Roland, a Rebel Tycoon. Tiny Roland, for those who don't know the story, was a very big name in, I guess, the 70s and 80s in the UK and Africa. One of the big mining entrepreneurs, very colourful character. The book's fascinating. His story. He's an Anglo-German. He spent World War II in an internment camp in the Isle of Man. Went to what was then Rhodesia and ended up after a pretty mediocre start to his career, it has to be said, turning into this super tycoon. Fascinating story.
And for those of a certain vintage can remember the huge takeover battle of Harrods, the department store. So there's plenty to chew in on that book by the sounds of things. George, thank you very much. I think we'll finish now and we'll talk again soon. Thank you.